And now to welcome Win Bischoff as the chair. And here the panel has this imaginative, I think, title of Imagining a Sustainable Society, the Role of Financial Services in the Future of that Infrastructure and Energy. And Win is joined by Jason, Christine and Dima, and I'm not going to spend any more time introducing you, if I can say it like that, and hand over to you, Win. Thank you very much.
Thank you very much, Stuart. I thought the panel, the last panel, was in fact extremely interesting, looking perhaps at the more traditional types of banking and the kind of support that it gives. This panel looks at financial services on infrastructure and energy. Now, we talk a lot about infrastructure, obviously. It is much more long-term by nature, and therefore the whole aspect of bank finance as against equity finance, as against the involvement of pension funds and so on will be quite interesting. And we've got a panel which is, in fact, the members of which will be able to cover that. Given the economic difficulties, obviously, there is quite a lot to talk about infrastructure. Should we, in fact, be investing for the long term? Should this be the kind of thing that actually is going to be a driver for growth in the country? I have, as chairman of Lloyds, I have a Lloyds Banking Group, I have a particular interest in this area because it is a part of the economy which is going to be hugely important for the future. And we ourselves are quite involved in this. The provision of corporate lending to construction and to utility industries, such as, for example, not just in this country, but in Germany for the Merwind offshore farm, which is located 50 kilometers off the German coast, the issuance of bonds in this country to local authorities, known as muni bonds, to finance, for example, Crossrail or part of Crossrail, and the public-private partnerships involving the long-term service delivery and the infrastructure concessions. But at the centre of this debate is the idea that the future funding of UK infrastructure cannot be expected to rest solely on the shoulders of the public sector. We have to involve the private sector. Recent legislation has accentuated this shift from the public to the private sector, and it is no longer so attractive for local authorities, given also the financial condition of central government, to turn to the Public Works Loan Board for funding. And much is to be said for making more effective use of private sector skills. Now, to make this work, we need to see greater clarity from government, but how? By providing more certainty for funding through the whole life of the facilities or the project. Certainty, regulatory certainty is going to be quite important. I mentioned pension funds right at the start. There's a greater role for pension funds, both private and public, in infrastructure funding. For example, via startup funding for a new national infrastructure bank. This was one of the key recommendations of a recent report called Credit Where Credit's Due by the local government think tank Localis. Some debate on private sector finance in recent years has focused on those aspects of PPI that have not worked well, even though much has gone well and important lessons have been learned. Traditional public sector procurement does not have a track record of unaffected success, of unalloyed success. And key to the success of any procurement is informed and skilled customers, able to negotiate robustly but against a well-defined initial specification which remains largely stable through the design and build phase. So, in summary, we need to change the terms of the debate. We need to foster a political and financial environment in which the funding needs for infrastructure projects can be met by the public and by the private sectors, working in partnership and with risks and rewards appropriately transferred between the two parties. To address some of these issues, we have a distinguished group of panel members. I won't, in fact, go very much into their CVs. Jason Channell, who is the Director of Investment Research and Analysis at Citi, and he's dealt with a number of these aspects, particularly in energy and in energy and infrastructure. Christine Farnish, who's the Chair of Consumer Focus. I and many of you probably know Christine from her time as a Public Policy and Sustainability Director at Barclays, and before that she was the Chief Executive of the National Association of Pension Funds, and I hope that she will in fact be able to say something about the pension fund side of things and how appropriate this may be for long-term growth of our pension funds and the returns, obviously, for the members. And lastly, Dima Rifai, who is the managing partner of Paradigm Change Capital Partners, which advises raising capital on investment strategies and collective funding vehicles in the low carbon space, which has also become very much more of a topic. I will ask each one of our panelists to address, to have some opening remarks for 4 minutes only, to give you all a chance to ask questions and to catch up a little bit of time. So with the firstly, therefore, I'll turn to Jason. Jason, to you.
Thank you. I thought I'd just start with some figures today, just to sort of set the scene for the scale of the opportunity here. The IEA estimate that the EU needs to invest $2 trillion in power generation by 2035. The vast majority of that is into clean technologies. There's only about 150 billion of that is into coal. And the related transmission distribution spend with that change in the energy mix as well would be a further $1 trillion. So that's $3 trillion just in the EU, and that is just the extension of existing policies as well. If you were to move to the 450 parts per million scenario, which is the widely accepted scenario to keep global warming down to 2 degrees or less, you would need significantly more to be invested. When you look at that globally, the figures are actually staggeringly large. It's 17 trillion that would need to be invested globally. And if you take the sort of clean energy part of that, and if you include gas as a transition fuel within that, and the related transmission distribution spend, then the spend would be $12 trillion between now and 2035. So very, very big numbers that we're talking about, and an enormous opportunity that's there to be seized. So looking at what mechanisms work in terms of facilitating this kind of change in the energy mix. We've seen feed-in tariffs, most notably in Germany. We've seen production and investment tax credits in the States. We've seen ROCs in the UK, green certificates in Italy. And I think the lesson that comes away from this is that the stability of a system is what makes it better or worse. And although the sort of the fixed feed-in tariff systems have often offered lower rates of return than the sort of green certificate markets like the UK, you've actually seen far better deployment in those countries. Why are some countries like Germany better? I mean, I think just a slightly controversial comment here, are they better? Certainly more has been put into the ground, but arguably those schemes were too attractive too early on. They attracted too much competition in, which has pushed down the price, led to a massive legacy bill from consumers. The German solar subsidy scheme is now 10 billion euros a year, which will run for 20 years for something that delivers about 2% of their electricity. They did develop an industry, yes, but because there was too much competition that came in, much of that manufacturing has now gone to China, and a lot of those German companies have filed for bankruptcy. So I think there's a question mark there about, what is the definition of success? And lastly, why don't we do it ourselves? I think the point I would like to make is that the money is there. The complaint from most equity investors is that there aren't the there aren't the vehicles for them to invest in to gain access to these sort of global megatrends. And I think there is an opportunity here for London to sort of capitalise on its standing as a global financial centre and one with a history of innovation. So all I would say is stable feed-in tariffs. We need to look at systems like tax credits. We need to look at systems like green bonds, which are coming in. We can talk about that later if there's questions on it, because debt is obviously around about 75% of the financing for these assets. And I think we should certainly look at something which has come up again and again this morning, which is institutions like KfW in Germany. So I'll leave it there.
Jason, fantastic. Very good. Christine, can I turn to you?
Thank you. 4 hours into the proceedings, at last a consumer voice. So I'll try and do justice to this task. What do consumers want from essential services like financial services and energy? Well, they want access to decent services. They want them on fair deal. They don't want to get ripped off. They want to make sure that those who give them the services, they want to feel they can trust them and they're going to treat them properly. But consumers also want jobs. They also want access to a better future for their kids. So they do have a real interest in sustainability and sustainable growth. And I was a bit shocked to see that chart that Mario Nava put up earlier, because to think that Europe's the only part of the globe that's implementing that enormous financial stability reform agenda that was invented in the heat of the storm in 2008 and which rolls on in this part of the globe, which others are thinking twice about, and which possibly doesn't deliver enough on sustainable economic growth, rather worries me. However, let's turn to energy. There are huge challenges, as we know, with modernising ageing infrastructure, particularly in the UK, but also across Europe. We've just heard what the price tag is. The worrying thing from a consumer perspective is that most of this cost is going to pass through to them in terms of bill increases. In the old days, taxpayers would have picked up the tag by and large. If you actually look at investment in energy infrastructure between 1990 and 2010, the last 20 years or so, 2/3 of it was through taxpayer funds. Only 1/3 of it was through consumer bills. Look ahead to the decade that's coming towards us, up between now, well, it's less than a decade, and 2012, and about 70% of the total cost will come through charges passed through to consumers and customers, and only a small proportion, relatively speaking, will come through public funds, and most of that will be through nuclear-type investment and subsidy. What does this mean for consumers? Well, here in the UK, by 2030, it will mean that virtually all households will technically be living in fuel poverty. Quite an eye-watering thought, with actually some political consequences, I would have thought, unless this is handled very carefully indeed. Of course, consumers used to be hooked on cheap credit. Maybe they were also hooked on cheap energy. And the UK has a particular problem here as a cold country in Europe, which has not really thought much about energy efficiency in the past, and where heating a home in many parts of the country is like filling up a bath full of hot water without a plug in the bath. So what needs to happen? We need to think more about the total cost of these policies we're implementing on infrastructure renewal and how they pass through to different groups of customers and over what time frame. And I do think the financial services industry has a huge role to play there in helping spread this major investment that's going to take place over one generation, which will affect consumers and beneficiaries in the economy over many generations if it's done in the way that's planned. So there's something there about distribution of costs and fairness. There's also something about changing consumer behaviour and doing something to reduce demand. And nothing like enough effort is going into this, as far as I can see. Far too much is going into high-tech, jazzy, supply-side innovations. We need to think far more about how we change people's behaviour. I'll stop there, else I'll be guillotined.
Terrific. I mean, it is actually quite interesting that consumers, of course, are taxpayers too, and actually how you balance this, and that's the very point that you've made, is very interesting, and how you, in balancing it, how you can actually spread it over a period of time so that those people, it isn't just going to be the next generation, it's perhaps the generation after that which are also going to be paying in an appropriate way, and then, of course, the conservation of it all. Now, on that, perhaps I can turn to you, Dima.
I feel like the bad wolf on the panel now because I'm going to talk about all the commerciality side of things rather than the poor consumers. I guess I want to talk a bit about how capital is moving around and financing infrastructure, and particularly sustainable energy part of infrastructure. And if you look historically, the industry was quite small and nascent, and probably 2004 was a real kickoff when Germany introduced feed-in tariffs. And it was primarily a clean tech world where it was technology, and most of the money that was coming in was venture capital type or angel money, if you could call it that. And then the industry grew up, and a few people made it past the kind of finish line there and commercialized, and the money that was needed became larger as people started to kind of scale out. And now we're in full scale out where we're talking about infrastructure. And infrastructure is hugely capital intensive, and the numbers have just multiplied out of control compared to where they were in 2004. Well, what's interesting along those lines is who's provided that capital. So there's been a variety of different players who've taken turns at providing the capital. Banks were not there in the early days, for instance, so the whole debt crisis would have been relatively meaningless in the venture capital days. Would have been somewhat meaningful, but not really as meaningful as it is in the infrastructure world. And so you look and see kind of governments were there, well, angel guys, kind of governments, corporates, because they bought some of these venture capital companies as they grew up, and so there were trade sales there. And then, you know, we came to 2008 and the big blow up, and everyone looked around and said, oh, gosh, this industry might come to a halt. Who's going to bail us out? And all of a sudden, kind of the stimulus side of government money came in, because before it was the subsidy side, different pots of money, but still government. multilateral banks stepped into the game in a big way, and they kind of gapped the debt side of it, if not the equity side of it. And now we're all kind of looking around going, okay, we've pretty much tapped out all those sources because the multilaterals are now all pulling back. And everyone's looking at the institutional investors going, oh, you guys are the next big pot of money. So everyone's looking at the pension funds and insurance companies and sovereign wealth funds and hoping, more than really knowing, that they're going to be the next guys to finance this whole infrastructure game. And what's interesting about that is that each party that comes in requires a different vehicle to play with or to play through. And that is partly because of the way that they need access to control, the way they need access to economics, the way they need access to tax structures. And so the vehicles have had to shift and change to attract these different types of players as they've come in. And as part of that, the multilaterals have had a role to play and continue to play a role. So even though they've pulled back on total volume, they're now starting to use their money much more efficiently. So they're thinking, how do they enable vehicles rather than create or substitute for those vehicles? And so the way going forward now, from talking, I sit on the advisor group of the Green Investment Bank. We talk to the EIB quite a lot. We talk to the KfW a lot. We talk to all those, large OPEC, you name them, we talk to them. And everyone's kind of putting their heads together now saying, look, we don't want to keep throwing just big money at this thing. How do we enable private capital? So the big buzzword in the multilateral world is, how do we use our money to leverage in private capital? How do we de-risk the process sufficiently to invite them in? And really the new story of the new vehicles is about risk sharing. It's about how people come in to finance these long-term structures that are, large and hugely capital intensive up front. And how do the players, the stakeholders in this, share the risks to each stakeholder's strength? Because there are operational partners, there are pure financial partners, there are MDBs and governments, there are NGOs that play a role. Every single person in that pot has to take a piece of it to make the whole work. And every structure takes a slightly different twist. So we spend quite a lot of time thinking about that, thinking about who are the parties that need to come to the table to make this happen. And the policy stability is key to all of that. It's absolutely key because even though, funny enough, kind of the super commercial guys now have gone off and forgotten about the subsidy world. They've gone for Africa, they've gone for southern Italy, they've gone for North Africa, sub-Saharan Africa, South Africa, or India, where they can substitute for diesel, kerosene, all these super expensive things where it basically washes its own back with no subsidy, right? But there's still a world out there that is, in Europe, dependent on subsidies. And until we balance the entire kind of electricity system in Europe, where you can use hydro from Norway, and that's really efficient at certain times, and maybe eventually we'll get to kind of grid parity, as we call it, and subsidies will kind of fade away into the past. But for now, we are heavily subsidy dependent, and every financing will depend on that and count on that predictability of subsidy. Am I running into my time zone?
Yeah, just about.
I have to keep looking at the clock. So it's how do we ensure that, and we work with governments quite a lot to give the financiers feedback to say, look, this is what they really care about most. If you mess this up, the whole financing game just unravels. And so a lot of that feedback is key. I'll stop there.
Great, thank you very much. What I think Dima has also has really highlighted is how much intellectual capital, not just financial capital, is actually needed in coming up with structures, and she says individual structures, which will allow the financial partners then to, in fact, earn their return. Secondly, I think what is very important is that there's a lot of money out there. There's a lot of money particularly seeking a return and seeking a relatively safe return with some risk attached to it, given the fact that government debt and so on is not necessarily the very best use of people's liquidity. So there is money out there. It's a very large amount of money, but intellectual and innovative ways of, in fact, making that money work is really what you're talking about. So with that, perhaps I can turn to all of you and ask our excellent panel a particular question that you might have. If you wish, you can direct the question to any one member of the panel. Otherwise, in fact, we'll answer as we see fit. So, yes, please.
Zach Wilcox from the Center for Cities. The National Infrastructure Plan really highlights the role of pension funds in investing in infrastructure and green infrastructure. But one of the major obstacles for pension funds is covering construction risk. Where do you see the major opportunities for covering that risk and working with banks and other lenders?
Jason, do you want to take that?
I mean, I think it's worth making the distinction as well between something like an individual asset, like a grid, which is essentially a rate of return asset. It is inherently a monopoly. It's a sort of thing, it's a very stable rate of return with, I'm not sure what it is now, it certainly used to be 5-year, I think it's 4-year now, regulatory reviews, which change the pricing scheme that you have on that. And it's a sort of an actually quite academic process which looks at the level of costs, what the levels of efficiency are, what the allowed return is. So one could argue, without treading on any toes, that it's absolutely perfect for a pension fund because it's a relatively long-dated asset. It's a very stable sort of part of return. If you're looking at changes for sort of generation, etc., I think that's a very different matter because your returns are far more volatile. And I think the key point we keep coming back to here is the regulation. The regulation is simply too volatile. And certainly, if my pension fund was investing in some of the companies that I look at on a day-to-day basis, I'm not sure I'd be too happy, and that would be fitting with the investment goals that I would have for my retirement. I think another example to give you is if you're looking at something like a wind farm. Now, a wind farm working on a 20-year feed-in tariff in various countries around Europe ought to be an extremely stable long-term investment. It ought to be absolutely perfect for something like that. What we've seen, though, is in this age of austerity, we've seen a lot of governments starting to backtrack from the sort of the feed-in tariffs that they've put in place. Now, whether or not it's putting taxes on the income from a solar farm, whereas previously it was granted a 20-year feed-in tariff or whatever, the stability simply isn't there. And I think one has to look at, I don't want to get too much into specifics on companies for sort of disclosure purposes, but there are large developers of renewable energy assets out there who are trading at below the sort of the face value of those assets were they to be traded in the market. And what Christine, that tells you is that the...
Sorry. I'm not going to cut you short, but I'd just like Christine to come in just on that point.
Well, pension funds sitting on piles of money, obviously looking for long-dated assets to invest in, and infrastructure, in theory, is a very, very good match, as we just heard. But there are a number of reasons why we haven't seen more of this. One is infrastructure is quite a specialist asset class, and traditionally pension funds haven't necessarily had those skills and haven't necessarily had the expertise to look seriously at it and put more money in. Secondly, manager fees have tended to be rather higher than pension funds want, and there's a real issue there that needs to be sorted out if pension funds are going to invest more of their money. Thirdly, there is this problem with construction risk, which, quite rightly, pension funds wouldn't necessarily want to shoulder a lot of that, wouldn't be allowed to anyway, and shouldn't. So who's going to take that on? I mean, I would have thought there's a role for government here. And there is, I think it's essential that government does have a piece of skin in this game of modernising national infrastructures. After all, it's essential for future economy. It's a huge efficiency investment in everyone's interest for it to happen. So it's a question of matching this pool of money with the need. And if governments could take on some of that construction risk, we'd really be able to make some progress. So I think those are the things that need to be sorted. But just finally, there's one other thing that needs to be sorted, and that's the European regulatory regime, particularly Solvency II, which, looks as if it's going to get in the way of this happening unless we can sort that out.
Thank you very much. Is there another question, please? Yes.
Hello, I'm Victoria Harrod from Freshfields. I'd like to ask Dima in particular about her views on the EU 2020 Project Bond Initiative and what role it might play in the increase in investment in infrastructure in your sector.
Dima, can you actually explain what that is?
Sure.
Yeah.
So the EU 2020 Project Bond Initiative, PBI as we affectionately call it, because we're in finance, everything gets cut down to an acronym that no one else knows. So it's basically a risk-sharing mechanism between the European Commission and the EIB, where the EC will allocate, let's say, liquidity to be accessed by the EIB. The EIB will do all the homework and the structuring to do the ultimate instrument, which is going to be a first loss piece in a bond. It's supposed to be similar to a securitization, but it's not. So it's not meant to be an aggregate of different assets. It's meant to be one asset per project bond. So it will be like a mezzanine piece, a first loss piece, if you want to call it that. And they are looking at doing it across three main industries. One is 10T, which is transmission, 10E, which is energy, and broadband. And so at the moment, it's not contemplated it's going to touch sustainability. Because most of our stuff is really in the generation side. There is going to be some transmission. We have in the UK here OFTOs, which are the offshore transmission operators, and those will qualify for the transmission, and they are looking at that. There will be a lot of interconnectors in Europe that could potentially qualify as being dedicated or mostly dedicated to renewables. And so there will be some application process there. But the bottom line is the structure is what's interesting. And what is interesting about it is the fact that it is a government-like, quasi-government, a multilateral, coming in and saying, look, what it's going to take to get these big institutional investors in is to get the rating up to a certain level on the senior piece. How do we get it there? And that's what's going to access the deepest pool of capital. Well, the way to do it is to create a mezzanine piece. We'll take the risk, but we will price it commercially. Now, it's a price discovery process, so we'll see where the real price comes out. But it's not going to be a grant. It's going to be a commercial instrument. And we are actually, the GIB is also looking at doing something similar eventually here as well. But first, they're going to watch what the EIB does with the pilot.
Right, we've got time for one more question, and then I'll do a quick, very quick summing up. One more question. Yes, please.
Thank you. In the light of recent American experience, what are the implications of unconventional gas for Europe making these big decisions about investment in energy infrastructure right now?
Jason, do you want to take that?
Yeah. I think there are two schools of thought on this. One of which is that shale gas is a nightmare for the renewable energy industry and is the death knell for the industry. The alternative view on it is that it is a transition fuel which gets us away from coal and dirty generation towards a lower carbon environment. And I think it's more positive to take the sort of second approach there, because I think experience tells you that sort of to shout in the face of the wind of these things when it's so overwhelming is perhaps not enormously helpful. And I think there are ways that you can work the two together. I mean, there's a lot going on in concentrating solar power at the moment where they're looking at dual-fired power stations. So what you're doing is you're having a conventional genset alongside a tower CSP system, so that's generating in the day. They're putting storage on that, up to 3 or 4 hours of storage of the energy in molten salt vats, which allows them to run. And of course, if the sun isn't working, you can simply run the gas-fired generator as well. And the important thing there is because it actually ensures your availability, which allows you to get extra payments for the grid, which means the return on the whole project comes up. So I think it is undeniably standing partly in the way of the development of renewables. But I think what the world needs to do is to embrace the fact that it is there, and they have discovered a good couple of decades of new cheap energy that perhaps people weren't expecting that was there, and to try and build an integrated energy complex. I mean, but I would also make the point that shale gas at the moment is and I don't want to sound naive here, there's clearly a lot of it in Europe, but if you're looking at the moment about the impact of gas prices on the development of renewable energy, it is far more of a punishing effect in the States than it is in Europe, because the US gas prices are far lower.
Good. Christine, anything on that?
No, but I'd like to pick up.
Yes.
It's probably the last time I'll get the mic, Chairman. So I just want to come back on
It is the
something
last
you
time you
said
get the
earlier, which is that I think you suggested that bill payers, consumers, are of course taxpayers. Well, of course they are, but I would just like to point out a very strong difference. Well, several differences really between costs being picked up by bill payers, consumers, in all their shapes and sizes, and costs being picked up by taxpayers. I mean, the differences are obvious. First of all, taxpayers, the public purse, standing behind the cost of something. Governments have the ability to spread costs over much longer periods of time. They also receive tax from a range of different sources, and tax tends not to be quite as regressive as charges for an absolutely life essential service like gas or electricity. And if you just think about the way those costs land on you as a customer, you've got a big chunk of fixed cost, your standing charge, and then you've got your variable charge on top. The standing charge part of that bill structure is quite regressive. Everyone's paying the same. It doesn't matter whether they're a very small user or quite a big user. And so there are some quite strong differences, I would suggest, between consumers through their bills for these services paying for the cost of this once-in-a-generation required huge investment and it being paid for by taxpayers.
I think on that note, we probably finished. I would agree with Christine, incidentally, in relation to some of her points made. Some of the base costs, the capital costs, may in fact need to be met by the taxpayer more broadly because the tax system can spread it. But the standing charge, the running charge, of course, Christine, you probably agree, the usage charge should in fact be appropriately met. We've looked at a number of things. What I think is very, very clear, I think hopefully is clear to all of you too, is that this is a very, very complex area. People talk with gay abandon about the importance of infrastructure and if only we could do more infrastructure, but I think finding the kind of models which will make it sensible, finding the kind of models which involve large different capital providers. For example, we are all very much aware that Australian and Canadian pension funds do actually invest very heavily. Ontario teachers, for example, the Australian super funds and so on. But we have to find a way whereby we can actually get other people involved, the banks involved, obviously. As we know, as some of you know, that Government of Singapore Investment Corporation is a big investor in infrastructure. There are some sovereign wealth funds which, in fact, are going to be investors. But finding, and as Dima has said, finding the right sort of structures and the right kind of vehicles for this. But the money, I believe, is there. It is complex. It is not going to be easy, but it is going to be hugely important for the development of our economies. Thank you very much, and I would like you all to join me in thanking our panel.